Welcome back and welcome to Homes Today. This is a proud presentation of Audrey Forshey, who is a beautiful realtor and a brilliant advisor at Remax Realty. In each presentation, she brings in a wealth of information on and about homes. Today, her guest is Michael Brozovac. Let's catch them in conversation.
Welcome to Homes Today. My name is Audrey Forshey and I'm a Remax agent in Montgomery County, Maryland. Today we have Michael Brozovac, who is a financial advisor, to talk to us about downsizing with your family home. So a lot of people are coming to me nowadays and saying, Audrey, we need to get out of our big house that we raised our kids in and we're ready to downsize and go retire. So what we're doing is there's a lot of decluttering in the house and a lot of getting rid of things, giving it back to the kids, moving things out, selling things, and getting the house ready for the market. So that's a big part of the process. And getting it on the market, selling it, and then looking at what this now means to you as a seller in terms of the money that you'll get from the sale of your house. So you know that for the IRS rules, if you've lived in the home for 2 of the last 5 years, it is considered your primary residence, and if you're a married couple, you should be able to take a $500,000 deduction, right, off of your income taxes in terms of a capital gain. So a lot of people have a lot of questions about this because they probably are selling their houses for more than that, and we want to talk to Mike and see what his perspective on this is with his industry. So, hi, welcome back. Thanks for coming.
Well, thanks for having me.
So, downsizing, you have that in your industry also?
Absolutely.
Yeah, I have a lot of those right now. So, how does it look from you? So, what I said, they have a $500,000 deduction.
It's an exclusion.
Oh, is that what it's called? Okay. And that takes care of or replaced that old 55-year-old $500,000 exemption. Funny enough that this has been a law for a while, and I still have people that ask me that, and they still ask me if they have to pay more for the next house than the house they just sold, which is not the case, right?
Not anymore.
Okay.
And again, this is where their tax advisor comes into play, but you're absolutely right.
Right.
A lot of people still think about the old rules, where they would have to buy a bigger house or pay more for their house so then they didn't have to take the capital gains in that transaction.
Right.
And then they just would delay it until they go ahead and downsize. The rules changed.
Okay.
So now the rule is, just like you described, it's $500,000 exclusion for a married couple, okay, against their capital gains.
$250,000 a person.
A person,
okay.
Exactly.
All right.
And the big thing here to remember is it's 2 out of 5 years. So with the old rule, you could only use it one time.
Okay.
The new rule is you can use it as many times as you want.
Right.
The key is it's your primary residence.
Right.
And you have to reside there 2 out of 5 years. It doesn't have to be consecutive 2 years.
Right, I knew that.
Yeah, so you're asking about what we're seeing in my practice and we're seeing in the industry as a whole. And especially in this area, we're seeing a lot of downsizing. We're seeing people saying, you know what, I want to unlock the equity of my house.
Right.
The kids are all gone now.
Right.
I don't need to take care of an acre or 2 of land anymore.
Right.
And I really want to get on with retirement. And so sometimes for a lot of people, that means going south. You know, downsizing and buying a smaller home.
Right.
Okay. So what we look at in our industry is that is an asset on your books.
Okay.
Right? That's part of your net worth.
Right.
And you may use some of that asset to fund your lifestyle in retirement.
Okay.
So before you get there, it's very important to understand what you're going to have net at the closing.
Okay, right.
So hopefully you don't have a mortgage when you're that age and you're ready to retire and pay off the house, but some people do.
Right.
So of course that's the first thing that comes off.
Okay.
And then second is you look at what you bought that house for.
Okay.
And another misnomer with a lot of people is that what they paid for the house and what they sell it for, that's their capital gain. Okay, and they're thinking that's what they're going to owe taxes on. That's not the case.
Okay.
Okay, what you pay for is your starting point. Okay, And then if over the years you've added improvements to the house, so you remodeled the kitchen, or you remodeled bedrooms or bathrooms.
Or an addition or something like that.
Absolutely. You put a pool in.
Okay.
That adds to your basis.
Okay.
And that's very important.
Okay.
Because as you're getting ready to sell that house, you want to start remembering all the fixes that you did around the house as far as improvements go.
Okay.
So cutting the grass doesn't count. That's
Right.
maintenance.
Right.
Okay. But if you put in landscaping to improve the value of the house, okay, that will help improve your basis.
Okay.
And so that's very important because especially around this area, we see it a lot where you may have somebody who's lived in Bethesda, for example, a very good market. They bought a house 40 or 50 years ago. They only paid $30,000 or $40,000.
I know.
And they're getting
amazing.
it is, isn't it? They get $1 million and they're knocking the house down because it's just really
Yeah.
the land and the location that's the value.
It's amazing.
Yeah.
So then when they sell their house and, their agent has potentially worked up their net sheet for them and they see where they are, and then they take their, they take their improvements and then their exclusions or their, what did you call it? Not a deduction.
It's an exclusion.
It's an exclusion. I can call it that.
Yeah.
Okay. So once they do that and then they have the leftover monies,
Mm-hmm.
that then is their gain. Is that what they're paying capital
That's
gains?
what they're paying capital gains on.
Okay.
And so, and understand, in Maryland, if they sell in Maryland,
Okay.
and we'll just use Maryland, if they sell in Maryland, that capital gain will be taxed at the Maryland's income tax rate. There's no preferential treatment on the Maryland tax return, so each state is different.
So what
okay?
does that mean, no preferential treatment? What does that mean?
That's a great question. So let's just take for an example,
Okay.
that you have a house that you bought years ago for $100,000.
Right.
Okay. You made improvements in that house
Okay.
with another $100,000.
Okay.
And then you sell the house for $1 million.
Okay.
After closing costs and so forth, it's $1 million.
Okay.
Okay. So your capital gain without your exclusion, okay, is $800,000.
Right.
Right. $200,000 in basis. You sell it for $1 million.
Yep.
Right. So on the surface, you have $800,000.
Right.
So now you can take, if you're a married couple, your $500,000 exclusion.
Okay,
And then you
gotcha.
bring it down to $300,000.
Okay, gotcha.
Okay, so now $300,000 is going to show up on your tax return.
Okay.
Okay. If it's long-term capital gains, which it is for this house,
Okay.
you're going to pay 15% in capital gains. Okay. Now,
For the state of Maryland.
no, for the
Oh.
federal government.
Oh, okay. All right.
Okay. Now, you need to check with your tax advisor because
course.
other income, okay, that's taxable, parts of Social Security, part of your pension, let's say, other income from dividends and interest may push that long-term capital gain much higher.
Okay.
Okay, because we've went through some changes with the Affordable Care Act that may tax an additional portion of that.
Okay.
So that's why you want to check with your advisor.
Okay.
But specifically speaking with Maryland or with many states don't recognize preferential treatment of capital gains. Okay, they look at it as ordinary income.
Okay.
And so if your income tax in Maryland is 7.5%, then you're going to pay 7.5% on that $300,000.
Okay. All right.
So you have to keep
No
that
matter
in-
what.
No matter what.
Okay.
So the important thing is, as you worked up your worksheet for your seller,
Right.
Your seller should take that worksheet along with all their basis and what their cost basis and any improvements they made, okay, and work with their financial advisor or work with their CPA or tax advisor and then look at what they're going to net after taxes.
Okay.
Because the tax bill won't be paid until the following year.
Right.
Mm-hmm.
So then they take that money and then they can give it to you essentially and maybe use it as income or that's investment money now or how do you, what do your folks do? I mean, I know
Yeah.
everybody's different,
Right.
but a good thing is that they have that money there and they can use that to live off of.
Absolutely.
But they should invest it, right? I mean, maybe they need to be conservative because they're older. Or, I mean, I know it's all different, but is that what they're doing with it?
It all depends on the situation, but what I can tell you is this is where proper planning comes into play.
Okay.
And let me explain proper planning. So let's
Okay.
say that you decided to downsize before you hit your full retirement age with Social Security. And we
Okay.
see that a lot in this area, where
Okay.
you get a pension if you work for the government.
Right.
And you decide that you're done at 62 or 63 years of age.
Okay.
Okay. Once you sell your house, once we go through the whole figures of what you're going to net, okay, that's after-tax money that you're going to deposit into an account.
Okay.
Now, any interest, dividends, any gains you earn on that money will be taxable.
Okay.
But if you work with a planner or an advisor or with your tax professional, you can look at how much you can pull that money, because it's not going to show up on your tax return anymore. Okay, so if that $300,000 that we just talked about is taxable, and let's say your after tax is going to be $200,000 you're left with after you pay all the taxes and so forth, and that's a very low number, and we're just using hypothetical. But that $200,000, you may say, well, you know what? If I can live off of that for a few more years, I can delay my Social Security.
Oh, okay.
If you delay your Social Security after full retirement age, you're going to get an 8% increase each year you delay it, up till 70.
Okay. So you can wait until 70 to take your Social Security.
Absolutely.
And then that gives you more each month to do that. So that's a good idea. Or and then if you have enough in there, you could just, I guess, live off of your, your dividends or that kind of thing, I guess, from there, and wait on the Social Security.
Well, there's so many different planning techniques. So, and this is where you have so many variables, you really need to sit down with a professional.
Of course.
And look at all your different options. So, another option is living off of some of that money, but bringing that money on your 1040, your personal tax return, so it's not really going to show up if you're taking it from principal, for your daily expenses. So if you put yourself in a lower tax bracket, it may put you in such a low tax bracket that you may want to withdraw some money from your IRA, because now it's not going to be that taxable.
Oh, very
So there's all types of different strategies that you can do. I guess the most important thing is you really should sit down with somebody who can work through all different options and look at the tax treatment of each different option.
Okay,
and look at the different cash flow needs that you may have, because everybody's different.
Okay, so what if let's talk about downsizing and maybe some advice to people that, let's say they do owe money. Let's say they put their kids through college with their house or something, because a lot of people do that. They paid it down and they've got big, college is expensive these days, right? And so let's say they have that, that they owe the money on there. Is there advice to those people, or is there, I guess this is really a tax question. So let's say that the fact that they owe that money isn't a difference from their base, right?
Absolutely, and that's a great question, and I get this all the time. And you're right, it is a tax question, but there's a difference between what you owe on your mortgage and your base. The two do not go together when you're factoring in your taxes. Your basis, right, your cost that you begin with purchasing the house and any improvements you made, minus what you sell it for, that's what's going to show up from a taxable standpoint. From the mortgage, I mean, I hear this all the time from clients. Well, I owe $400,000. I'm selling the house for $1 million. I'm going to have capital gains of $600,000. The mortgage has nothing to do with your tax basis.
All right. And so then, in terms of those folks that may owe the money, and then owe the taxes the same, do you advise them a little bit different? Do you try to say, maybe you should keep the house, maybe you should stay in the house, maybe you should, no, you shouldn't get rid of it now, or you should get rid of it? There has to be that conversation also, right?
Absolutely. Absolutely. And you have to remember, is the house meeting the purposes, and sometimes it did because you raised your family, and now the family is gone, the children have left the nest. You have to remember that there's always going to be a cost to maintaining that house. It's an investment.
Of course.
And so you don't want to let that investment go without the maintenance, that's proper maintenance for the house and so forth.
Absolutely.
And so what happens is, as we get older, we want to simplify our lives. And do we want to take care of an acre of land? Even if we want to have a landscaper or somebody to cut the grass.
That costs a lot of money.
It costs money.
And it costs a lot of money, that does.
Yes, it does. And so these are things that we factor in. The best way to look at it is just looking at your cash flow needs. What are your expenses? And what are your expenses in your current residence? And what would be your expenses in your new residence? And some people may find that they go from having no HOA fee to moving to a community where they're paying a couple $100s a month in HOA fees.
And there's some retirement, 55 plus communities, and the HOA fees are astronomical, but people like that because they have no yard maintenance, they have no exterior maintenance, which, just like you said, it's simplifying your life and all that sort of thing, and there's a value on that. They don't typically have mortgages on their properties, but they do have that HOA cost. So I think that sometimes it could be better for people to stay in their houses if they do owe a lot of money, but you know, like you said, they have to talk to their tax planner, they have to talk to their financial planner and all those sorts of things. Talk to your real estate agent, see how much your house is worth, how much net you have, and all that sort of stuff. So we thank you again for joining us, and we hope to see you next time on Homes Today. Thank you very much. Bye.